Anyway, let's talk about what's going on in the news and in the world, Jeff. There's a lot going on this week, a lot happening right now. Geopolitical tension, inflation data, bond moves, retirees are wondering what it all means for their money. So let's start with the headlines. The U.S. and Israel conducted strikes on Iran. Oil prices jumped a little bit. Markets reacted. What should retirees really understand or take away about this situation?
Well, it depends. If they've got an overall plan where they've kept enough of their money safe and protected so that their income doesn't get interrupted, then they shouldn't lose any sleep. If you've got everything in tech stocks and even gold and silver that's been selling off lately a little bit more than expected, sometimes it's a safe haven, it isn't. Depending on what your investments are, you might be a little bit worried, or you might want to reshuffle the deck a little bit. Energy and oil is certainly going to be strong given the nature of a Middle East conflict. It might be a little longer than expected. Hopefully they'll get in and get out. I don't know that ever happens in the Middle East. So there might be kind of a long-term deal. There'll be certain shipping and transport companies that are probably going to do very well as far as stock investments. We're moving to those now and been doing very well all week. We've got certain tech companies still have a niche and are still holding up pretty well through this week. Although if you look at the Magnificent Seven, the stocks that basically drove the market for the last few years, if you look at the 1 day, 1 week, 1 month, 3 month, and 6 month, the last 6 months, all of them are down, trending down, significantly down, 7% year to date or more. I think 8 or 10 maybe now by today. But those are the stocks that basically gave all the gains to the S&P 500, and all the others were flat compared to those 7, and those 7 are struggling. So some of the big companies that have been a little bit overbought, a little overhyped, are kind of settling back into reality. Certainly the conflict and the what ifs and how is it going to affect regular investors. And for those people that do live on their investments, they're probably running scared and going to be running for the cover and going to be selling and maybe a little bit overdone, given the fact that I think the economy, regardless of a war in Iran or depending on how big it gets and how many countries get involved, may or may not be a big deal from the standpoint of economics. But if it is a big deal from the standpoint of people's comfort zone, being in the market or being exposed to possible sell-offs or another 9/11 attack where the market shut down for 3 weeks and nobody knew what it was going to open up at, and everybody was 20% or more poorer when it did open. So I think some people do have a memory of that. Some people have no memory of it. But those people that do, or those people that realize that there is risk associated with war, might be running for cover. So that's why I think there might be a little bit more, over exuberance in the sell-off pressures or the volatility like we saw this week and probably we'll see on into the coming weeks. We're hyper vigilant from the standpoint of the stock market. We watch the money and see where it's going, and we make those adjustments in our portfolio accordingly. But when you're dealing with the big firms and the Fidelities and Vanguards and those big people that have trillions and trillions of dollars in funds, they really can't do anything but maneuver other than just ride the market out and tell you to hang in there so that all their friends and rich people can sell and take profits, and they can do the same and hope you can ride it out and not get hurt. But the thing is, a lot of people do get hurt when the market sells off. This is one of those things that is a catalyst for a typical sell-off or even the start of a good reason for a bear market. It may or may not happen because there's still a lot of money out there that is probably happy to buy stocks even at these overvalued prices and continue to drive them up. Nevertheless, we've seen hedge fund managers dial it back. We've seen Warren Buffett dial it back. We've seen Dalio and those other big, huge hedge fund managers that have trillions of dollars in investments basically raise cash lately. So they're expecting something to be a trigger or a catalyst to a market sell-off. And certainly this war issue isn't helping it. I think defense stocks, you might see some strength there. We already did earlier in the week with Northrop and some of these other stocks that build the planes and the missiles and stuff that they're shooting up and going to have to replace. Raytheon and things like that will likely do well during this type of a time frame. But if you've got a huge portfolio that has everything and they leave you diversified, the things that are getting hammered are going to be drawing your portfolio down. If you have an active manager like us, and we're not the only ones, but some people do hands-on tactical management, we're going to probably leave those ones that are soft alone and try to focus and kind of load up on those stocks that seem to be strengthening during this conflict, oil, defense, that kind of thing. So if you have money in the market you can't afford to lose, then you should be running scared, maybe dial it back a little bit and put something into some principal protected accounts. We do have principal protection on our LERPs, on our annuities, indexed annuities and indexed IUL, indexed universal life insurance policies that we use. Those are principal protected. Those are insured and secured accounts. The balance does not go down when the market crashes. It stays the same. Now, it goes up when the market goes up, and it doesn't go up maybe as much as we could do on managed money, but it gives you the safety net, knowing that when times like this come, when there's a lot of uncertainty, that you don't have to run in and sell half your assets at a loss. I mean, shoot, I remember Tuesday I woke up to a down 5.5% at the open, bounced back reasonably well, and we made some changes during the week. But if you're living on that money, you have a few days like that, you should have a gut ache. But if you've got 3/4 of your money in safe places and you don't have to touch it, and we can let it bounce back and give it some time before our next paycheck that we have to take out of that, because we don't have to take money out of that account, then we can be a little bit more calm and cool and collected about it. We can just kind of let the market do its thing, and we can let the managers do their thing, and we can live on the income that we've already set up to pay our bills and to give us a little bit extra for fun stuff. So if you set up a good comprehensive retirement plan, the ones like we set up, I really doubt. In fact, I haven't had a call yet this week of anybody worried like, oh my gosh, Jeff, this war am I okay? Am I okay? Because they know that they're okay, because they know that they're getting their monthly paychecks and they're coming out of principal protected accounts. They're not locking in losses, and that they can typically ride this out. Now, we may end up getting a few calls, but in some firms, when it's all or nothing markets type stuff, even stocks and bonds, and the bond market hasn't really held up that well lately either. Done okay, but over the last few years, we're still significantly down from their market high. So bonds are not necessarily a safe haven. Gold seemed to be kind of a way that a lot of the hedge funds were going, but we've even seen that gold and silver sell off recently. So what can you count on? I don't know. It's all kind of a guess. You have to use logic. You have to use reasoning. You have to use rationale. You have to look at where the money's going and try to follow that, which is what we do. And that's what people hire us to do, because they don't have access to the information that we do, that we pay a lot of money for. But, if you're not able to navigate the market and guess it, then you shouldn't be in it, especially if it's money that you need to use on a monthly basis or to supplement your living expenses, especially if you're retired or getting close to retirement. Now, granted, the people that aren't retired, maybe they're in their 40s and have 20 years to go, or even in their 50s and have 10 years or more to go, probably don't have to worry at all about these little market corrections. They can keep on putting money in. In fact, a little market sell-off would actually help them buy in at a cheaper price on a per stock share price basis. And they'd actually dollar cost average into more money in the future. The people that are still in the accumulation phase should welcome a big correction, because then you get to start low and you get to buy low and then sell high when you retire. If you've already retired, I hope you already sold at the high, because you should have taken profit. You bought low your whole life. Now you should sell at the high point. We're still at a very high point. We're just a few points off of record highs in all the indexes, even though the indexes, I think, year to date are down probably on average 3 or 4%. And for the last 6 months, somewhat flat. But if you look at the last couple of years, we did really good, and you're still able to get out with a nice profit if you haven't gone to take some profits and gone into some principal protected assets. I think now might be a reminder of how volatile the market can be when, bad news hits or some new macroeconomic event happens. And I would say a war is a macroeconomic event because it does filter into the economy, not just a geopolitical type thing. But there's times to rethink and regroup and reevaluate your asset mix and assess whether these assets are for long-term growth and you can wait on them, or whether they're for supplementing your Social Security and pensions in retirement, or whether you're going to retire in the near future. And who knows, maybe this is the start of the next big 50% correction. I don't know. I hope it isn't. We're certainly not going to ride it all the way down with our investment money, but people that are in the market, maybe they don't have a choice, or maybe they're coaxed into the mantra of Wall Street, hang in there, it'll always come back. Well, not if you're spending money, it doesn't come back. It locks in losses and you end up running out of money. So you have to be careful, depending on where you are in the retirement planning cycle, phase cycle, or in the retirement cycle itself, on whether or not you've set aside enough money to provide that guaranteed income that you need, or at least a predictable income need, so that your bills are paid, and that you have the peace of mind to sleep at night and to continue to live your retirement on your terms, not just based on what the market tells you you can do.